Hello and welcome to the Monday Futures Market Outlook for February 11th, 2013. This is Patrick Sresna. As always, those of you who have not had the opportunity to try out our E-mini Source trading room, complimentary memberships are available on the website. All of the content discussed throughout today's session is also available in newsletter format in our Market Timing Strategist newsletter. As always, we start off with a chart of the U.S. dollar index futures, and we've found some sort of a short-term low on the U.S. dollar as it bounced down toward the 79 level and found support, and has now worked its way back up to the middle of the range. We were suspecting that this was the most likely course, as the euro strength that has driven much of that U.S. dollar weakness was coming to a pretty big extreme. At this juncture, we do believe that the U.S. dollar will be stuck in a muddle within a range throughout the course of the year. And we are at the bottom end of this range. At this juncture, at any point moving forward for the next month or two, there's plenty of room for the U.S. dollar to strengthen back to the top end of the range, as our first target would be the highs from November around that 81.50 area. But throughout the course of the year, there's plenty of room for the U.S. dollar to even gravitate back up towards the 83 to 84 levels where we had the summer highs for bigger picture consolidations. Next year, I want to take a look at that euro currency, and we really see where that short-term high came in. We finished what we call our technical measured move to the upside that temporarily exceeded our overhead resistance, which was at the 2012 highs. But even that finished move to the upside immediately rejected. This is probably going to be where a key high in the euro is going to develop. Now, it doesn't mean it will be the high of the year, but it is likely that we're going to have an extended period of consolidation from this point on off of those highs, at least for several months. The likelihood that the euro still can muster up another round of strength, while there's always a room for a catalyst to cause that trigger, it's a very unlikely event, and it looks like we may have seen the intermediate high here. Next year, I want to take a look at the 30-year Treasury bond, and similar to the 10-year, there's been some considerable weakness over the last 3 months as it's consolidating off there. There's been over the last decade a pattern where Treasury bonds have acted as a risk-on, risk-off asset against the stock market and other things like that, with their room for U.S. dollar strength and potentially euro weakness. If we see a short-term stock market highs coming in, there's plenty of room for this support line to act as a foundation from which a 30-year Treasury bond can gravitate back to the middle to top end of this trade range, and even a small chance that it could actually resume into a brand new uptrend. While we're not going to look for that brand new uptrend to all-time highs, we do believe that there's plenty of room for the Treasury bonds to actually, on the interim, work their way back up. Next year, I want to take a look at the copper futures, and copper, again, we look at this as a very range-bound market, and we've now gravitated top end of ranges because we think we've seen some important lows on the U.S. dollar. There's a natural inverse relationship of commodities to the dollar trend, and therefore, as we gravitate to the top end of the range, and then accounting for the U.S. dollar strength, we think that there could be a top put in here on copper, which will allow it to gravitate back to the bottom of the range. We don't necessarily believe that will be a new downtrend, but simply the risk-reward proposition of owning copper is pretty poor here, and we don't want to, and we want to be sellers in general. Next year, when we take a look at crude oil, it's a similar outlook on crude as it is to copper. We were looking for a bottom back in November, and U.S. and crude oil has strengthened since then back towards the highs that it put in August and September, towards the 100 level. We do believe that this is where there's going to be short-term overhead highs, and that there's plenty of room for crude oil to continue to consolidate even down toward the mid-range of $90 to $92 on the downside, if not even an outright retest of the $85 level. While we don't want to be too ambitious on the downside, we want to at least simply imply that continuing to own crude oil at this point up here is not a very good risk-reward proposition. Next year, I want to take a look at gold and gold futures, and essentially the bullion has weakened yet again. This is not a very healthy pattern, but yet it's a very important support. If we see gold manage to still muster up strength here at 1650 and hold this support line, this is a very good level for there to be still yet a rally that begins in the gold markets. But yet at the same time, we've seen a continuous sequence of lower highs and distribution, which is not in any way implied that that there's a new motive move starting on the upside. And so we have a very mixed picture here. One thing for certain is that if the 1650 level does not hold, that would certainly leave room for testing of a support line all the way down along the lows of the summer, which would imply about 1550 or about $100 an ounce risk to the downside. And while we're not going to forecast that, we certainly do want to imply that any break of 1650 that holds and accelerates would certainly set that as the downside target. Finally, we're going to take a look at the S&P 500, and we remain pretty adamant at this moment that this is a very key level on the upside, and we see very little motive or incentive in order to remain in the stock market. While we think that it's a little ambitious to be rushing to short this market off of these highs, there's a lot of still complacency and a natural tendency for the market to still want to crawl higher along the way. But as a whole, the risk-reward proposition of owning the market here is pretty bad. We've in our newsletters and in our services, we continue to be exiting the stock market here, taking profits and moving to the sidelines along the upside. There is potential for the S&P to still make a pop up toward 1550. Not only is that the home of where the all-time high on the S&P lay, but also there are some much bigger picture measure moves that do suggest that, but it doesn't by any way guarantee that the S&P will get there. And so at this point, what the risk you're taking in trying to squeeze a few more points out of the S&P before a correction is, in our opinion, not worth the risk. Just to make our key intermarket observations, we do believe the U.S. dollar represents a good short-term risk-reward proposition. In the bigger picture, we think that it is range-bound and it's sitting right at the bottom end of its range. So the upside potential is actually pretty good compared to its downside risk. And at the same time, as we are seeing topping formations and things like the euro and broad weakness in a number of other currencies. At the same time, that would bode poorly for commodities. And as you can see, copper and oil sitting at the top of the ranges, it is likely that they can gravitate to the bottom of the ranges during this kind of cycle, and so continuing to own them is probably a poor proposition. At the same regards, bonds could do well in this environment as a risk-on, risk-off trade against the stock market, as well as U.S. dollar strength. So if supports hold, traders can look for some upside on there. We wouldn't recommend bonds as a long-term investment, but certainly as a short-term trade, yes. As for stocks, there's been some really nice runs in not only U.S. stocks, but as well on a lot of global indices, the European indices, Asian indices, a lot of different indices have done very, very well, while the trends are very distinctly up, and we don't even want to imply a new bear market or anything like that, but the risk-reward proposition of owning the markets and not taking your profits is a poor proposition in our opinion. That was your Monday Futures Market Outlook. Thank you for joining me.